Look at the stock market over the past few reporting cycles, and you will notice a severe trend affecting highly specific sectors. Financial services, enterprise software, and tech consulting companies are experiencing sudden, sharp valuation multiple compression. Historically safe, high-margin firms like Accenture, FactSet, and Atlassian are seeing their valuations punished by the market with little obvious internal catalyst. The capital bleeding from these legacy titans is not evaporating. It is being aggressively absorbed by a company that didn't even exist in 2020, an AI startup called Anthropic. This chart shows exactly where the money is moving. On one axis, the valuation multiples of legacy software firms steadily decline. On the other, Anthropic's revenue curve climbs at an astonishing rate, projecting $14 billion by 2026. That growth trajectory has pushed their private valuation to $380 billion. The market is pricing a 5-year-old, currently unprofitable startup higher than Netflix or Coca-Cola. This correlation is forcing a reassessment of what analysts call terminal value risk. The market is beginning to calculate whether the core services of legacy software firms can survive in a landscape where this level of revenue growth is accelerating. While competitors chase virality with consumer chatbots, Anthropic deliberately ignored the public spectacle. They refused to build video models or internet meme generators. Instead, they dedicated their engineering to the professional environment, shifting from conversational AI to what the industry calls agentic infrastructure. This diagram illustrates the structural difference. On the left is conversational AI. An AI outputs text, and a human takes the final action. On the right is an agentic workflow. You define the goal, and the system takes over. It accesses APIs, interacts with file systems, and executes the entire process from start to finish without human intervention. Internally, Anthropic estimates that over 70% of interactions routed through their API already display patterns of full end-to-end automation. By building the invisible infrastructure that executes corporate workflows start to finish, Anthropic is directly replacing the billable hours that legacy consulting firms rely on to survive. The technical architecture enabling this massive corporate adoption is a standard Anthropic invented called the Model Context Protocol, or MCP. This protocol map shows MCP functioning as a universal hub, connecting Anthropic systems securely with enterprise applications like GitHub, Stripe, Figma, and Notion. In practice, Claude autonomously reads proprietary databases, organizes files, and executes complex operations across multiple platforms simultaneously. Deploying this universal standard has allowed Anthropic to rapidly capture the most lucrative, entrenched sector of the software industry, the B2B market. Estimates indicate Claude's enterprise market share surged from 12% in 2023 to over 32% in 2025, completely surpassing OpenAI in the corporate sector. MCP acts as the essential bridge, elevating Claude from an isolated chat window into an integrated cross-platform operating system for the Fortune 500. The most aggressive, undeniable indicator of this disruption within highly specialized technical labor is a developer product called Claude Code. Shortly after its launch, this single programming tool began generating more than $2.5 billion in annualized revenue. To measure global software development output, developers track every code change uploaded to a project. This uploaded change is called a commit. Data shows Claude Code is responsible for 5% of all public commits on GitHub. Analysts project this figure reaches 20% by 2026. That is 1 out of every 5 lines of public software globally authored by this system. The shift to autonomous authorship is measurable. At its current trajectory, this system is transitioning into the primary author of the global software stack. This automated execution extends far beyond software engineering. Currently, 8 of the 10 largest companies in the world by revenue are active Anthropic clients. In the pharmaceutical sector, Novo Nordisk has adopted Claude-powered workflows to handle dense regulatory paperwork. This timeline illustrates the efficiency gain. By utilizing AI agents, the company reduced its clinical documentation processing time from more than 10 weeks to just a few days. In banking, the Commonwealth Bank of Australia integrated Anthropic models directly into their transaction monitoring systems. The bank reported a reduction in fraud-related financial losses of nearly 50%. Meanwhile, in telecommunications, South Korea's SK Telecom deployed Anthropic to overhaul its massive customer service operations. Their deployment resulted in an immediate 30% improvement across core service quality metrics. By compressing weeks of high-level labor into mere days, Anthropic is aggressively invalidating the hourly billing economics of legacy tech consulting and premium software pricing models. These corporate adoption metrics translate directly to an immense financial trajectory, achieving over 10 times year-over-year revenue growth for 3 consecutive years. This rapid scaling culminated in a Series G funding round, where private markets handed Anthropic $30 billion in a single capital raise. This revenue is structurally protected. Because Anthropic signs its clients to multi-year enterprise contracts, their future cash flow is locked in and highly predictable. Wall Street rationalizes this $380 billion valuation on 2 pillars: locked-in multi-year contracts and $14 billion in projected revenue by 2026. But an expected IPO will force Anthropic out of private markets, crashing this hyper-growth narrative into strict public margin scrutiny. The true test will be proving that their dominant software infrastructure can actually deliver the deep profit margins required by institutional public investors. The company also faces an existential threat from legacy tech giants who are scrambling to replicate these exact agentic capabilities. Massive, well-capitalized rivals like Google and OpenAI see the capital drain and are aggressively pivoting their models to contest this B2B infrastructure layer. Anthropic's primary advantage remains its pure focus on the enterprise environment, free from the distractions of consumer product virality or media generation tools. Over the next few reporting cycles, we'll see if Anthropic can maintain its technical moat before legacy competitors manage to commoditize agentic software entirely. The data forces us to evaluate a strict binary. Either we are witnessing a permanent restructuring of corporate efficiency, or we are in the middle of a massive valuation bubble driven by inflated expectations. Regardless of the IPO's final price, a new valuation benchmark exists. The market now measures legacy enterprise value against the cost of automated labor, leaving Anthropic to defend the infrastructure it used to disrupt the sector.